Now I want to talk about some threats that we see to hopefully what I've tried to portray, especially in the US, and actually an improving economy. Now some of the things that we're worried about last year and worried about this year includes Europe, China, and the US deficit or political situation. Greece is the poster child of what's wrong in Europe. We see it on the news all the time. The problem in Greece is they borrowed too much money and they had to get a bailout in order to pay their debts. Now, in order to get that bailout, they had to agree to the European Central Bank's wish for Greece to reduce their spending. The problem with that is that austerity or lower spending leads to lower gross domestic product. That leads to a higher debt to GDP, which means you have to cut more money or you have to cut more spending. It creates a deflationary spiral, and that's what Greece is in right now. Now, the good thing for Europe is that Greece is a relatively small country. You can bail it out. The problem is what we've seen in Greece is now happening or was happening in other countries such as Spain and Italy. And Spain and Italy are too big to bail out. In fact, Italy is the third largest debtor nation in the world. And you can see from this chart, it shows the 10-year government bonds for both Italy and Spain. In 2010, we were moving on quite nicely around 4%. And then last year, because of what was happening in Greece and the contagion, yields jumped up over 5%. In fact, in Italy, they jumped up over 7% at one time. At 7%, the debt that Italy has is not sustainable, and they're going to need a bailout, or they would need a bailout. And as I said before, they're too big to bail out, so that presents a problem. Now, as you can see, yields have come down. In fact, as of today, yields in Spain and Italy are below 5%. So part of the reason they've come down, definitely what's happening in Greece. The bailout package looks like it's going through. That's helped the environment in Europe. But the other thing, probably the larger thing, is that the European Central Bank has lent European banks 1 trillion euros for 3 years at 1%. A lot of that money was lent to Spanish and Italian banks, and those Spanish and Italian banks were buying Italian and Spanish bonds. So that helped stabilize those markets. Now, Spain and Italy, they do have a debt problem, but I think we have to put some perspective on that debt problem. If you look at Italy and you look at their deficit or their debt to GDP, 118%, that's high. But their deficit to GDP is actually quite low. In fact, if you take away interest, they'd probably be running a balanced budget. Italy's problem is their economy isn't growing, and it hasn't grown for years. Spain has the opposite problem. Spain has a very low debt, 61%, but their deficit to GDP is really high because they're in the midst of a crushing recession. But if we were to take these two countries and their debt and put them together and form a new country, what would it be called? I say Spitaly, but no, it's not Spitaly. It's actually France. In fact, if you look at where France is, they have debt to GDP of 82% and a deficit to GDP of 7.1%. It's almost exactly the average of Spain and Italy. So, I mean, you have to put this in perspective. We think a lot of what we saw last year was overdone as far as what was happening into the bond market for these two countries. Another way of looking at this, let's take it up a level. Let's look at Europe as a total, the 17 countries in the euro. Let's look at their debt. You would get a debt to GDP of 80%, their deficit to GDP of 6.6%. Compare it to the US, lower debt, lower deficit. And yet, no one was worried about the US debt. In fact, last year, as we showed before, US yields were going down as US was perceived to be a safe haven currency and bond market. So I think that, again, and we're not saying there's not a debt problem in Europe, but you have to put it in perspective. The real problem in Europe isn't debt, it's growth. And if you look at industrial growth of Germany versus Spain and Italy, there's a big difference. And what normally would happen in this kind of environment is the exchange rate, the currencies of Spain and Italy would go down, the cost of their exports would decrease, they become more competitive, and their economies would grow. Unfortunately, both Spain and Italy are using the same currency as Germany, and that adjustment can't take place. The only thing they can do is devalue internally, which means they have to cut wages and prices within their own country to be competitive with a country like Germany. Now, there is a couple other things they could do. They could leave the euro, which again is might help in the short term, but isn't going to help in the long term. They could try and convince, rather than taking deflation in their own countries, they could try and convince Germany to actually create inflation in Germany, but that absolutely is not going to work. There's no way Germany is going to go for that. So the real solution, the solution for Spain and Italy, is for them to become more efficient and productive, to try and become more like Germans, to work like a German. And that, in fact, is the German solution. Because Germany's answer to this is that 10 years ago, Germany would maintain that they weren't that strong. 10 years ago, Germany was considered the sick man of Europe. But they made some structural reforms. Basically, what they did is they decreased union power. They gave companies the ability to hire people knowing that if they needed to, they could lay them off again. They also reduced unemployment benefits. If you're going to pay someone not to work, guess what? They're not going to work. And so that was another thing they did. The whole goal of what Germany was trying to do is they're trying to get young people back into the workforce. The unemployment rate of Greece and Spain for youth, for people from 15 to 24 years old, is 50%, and that's a recipe for social unrest. Now, this process and this restructuring is happening in Spain and Italy, but it's not going to happen overnight. And in the meantime, growth in Europe is slowing. In the fourth quarter, we saw Eurozone GDP decline 1.3%. The only country that grew in Europe in the fourth quarter was France, which I don't quite understand, but there you go. This presents a problem for our next threat, which is China, because Europe is China's biggest trading partner. And you can see from this chart, it's the Shanghai Composite Index. You can see last year it was declining all year, finished the year down 23%. It's telling you there's something wrong going on in China. There's some concern in China. And what is that? It's slowing growth. And if you look at the red line, you can see that real GDP growth has been declining in China for the last 2 years. In fact, if we go through the quarters, you can see GDP growth has declined from 9.7% in the first quarter all the way down to 8.9% in the fourth quarter. Just recently, the Chinese government has come out and said they're targeting 7.5% for this year. If that were to happen, that'd be the lowest growth rate in 22 years. Now, they don't really expect to have only 7.5% growth rate. In fact, last year, they were actually targeting 8%, and they did well over that. But it does show you the trend of growth in China. And we would expect that to happen. You can't grow at 10% forever. Nobody can. And China is moving more towards a consumer-based economy, away from a manufacturing or export-led economy. And you can naturally assume that it's going to be, you're going to see growth decelerate. But the other thing you have to consider with this growth rate in China is that a lot of it was self-inflicted. China was more worried about inflation than growth last year, and they had to get inflation down. So they tightened their monetary policy, and you've seen that inflation come down, and you've seen the growth rate come down. They're now easing monetary policy. So the hope is that you avoid that hard landing, and you should have a nice soft landing in China. Now, the next threat that I want to talk about, and I've sort of already alluded to it, it's debt, government debt in the United States, which is quite a problem. Just to show you how bad the current trend is, if you consider that U.S. tax revenue, historically, has averaged about 18% of GDP. That's that red line. By 2050, all tax revenue would be used just for entitlement spending, just for Social Security and Medicare. And that's unsustainable. And you can bet the bond market's not going to wait till 2050 before they start reacting. And we can see what's happening in Europe to see what the impact of that would be. So clearly, you need to have some kind of answer. And the problem in the US right now is the answer has to lie with the Republican and Democratic parties. They have to agree to cut or raise taxes. And right now, these two parties aren't agreeing on anything. They're very much polarized in their beliefs, because the Republicans, their solution to the problem is they don't want to increase taxes for anybody. They think the problem lies with cutting spending. The Democrats, however, the Democrats would probably be okay with cutting some spending, but what they really want to do is they want to raise taxes. Now, they don't want to raise taxes for everyone, though, because it's an election year. What they want to do is raise taxes for the rich. And they're on pretty solid ground to do that, because if you look at recent polls, it shows that most Americans would favor an increase in taxes for the people, the 1%, the people making over $1 million. There's another problem in the US that we need the Republicans and Democrats to agree, and that is what is being referred to as Tax-mageddon, because that by the end of 2012, the end of this year, you've got the Bush tax cuts expiring, and you also have the payroll tax going back to a normal level. These two things alone are going to take $500 billion out of the US economy. On top of that, you've got the spending cuts that were agreed to in last year's budget ceiling. If you add all three of these up together, that should shave 3% off GDP. And if you're only thinking you're going to grow GDP 3% anyways, 3% reduction means you're perilously close to a recession in the US. So we need the Republicans and the Democrats to come to some agreement to address this, because neither of them want this to happen. Now, our longer term hope after the election, because quite frankly, we don't see anything happening before the election, we need some kind of grand bargain. You need some kind of bipartisan agreement in Congress such that you're going to have, and this is where it's going to end up, you're going to have higher taxes and you're going to cut spending. And it's an inevitable thing that's got to happen. You've got to have this happen before the bond market tells you you have to do it. And hopefully that's what's going to happen after the election. And this would be good for the US economy and good for the markets. Now, one other threat. I said there were 3 threats. There were actually 6. But if I said there were 6, you guys would have all headed to the bar and had a drink. So the other threat we're seeing in the market right now is potential war in Iran. And just on the threat of war, oil has increased over $100 a barrel. Now, when you translate that into gasoline, gasoline in the US is getting very close to the $4 a gallon level. In some states, it's already past it. This is typically a level where consumers start to pull back spending. And the consumers, 70% of the US economy, is a direct tax to the consumers, like taking money right out of their pocket. So this is a concern and a threat if there were a war in Iran, and you could easily see oil double. That would obviously change our forecast of economic growth in the US. Now, the other one is, as everyone knows, according to the Mayan calendar, the world's supposed to end on December 21st, 2012. So if that were to happen, then we would have to change our forecast. So we throw that one out as another threat. I know I personally will feel a lot better when I wake up on December 22nd. Now, I said 6 threats. The last one, I'm not even going to go into. I don't even have a slide on, but it's Japan. Basically, as bad as the fiscal position is of Europe and US, Japan is exponentially worse.